Welcome, Steen. We're very happy to have you here. We want to understand a little bit about who you are and where you came from. So let's get right to it. What came first, the chicken or the egg?
Classic philosophical dilemma. Of course, there are no solution to it, which I find is interesting because I think most kids growing up is being told there's always a solution to a equation or an equation. And I think in life, what you find as you grow older, certainly as old as I am, that very often there isn't really a solution. There is a interpretation of a solution, but never a solution. So the answer is neither.
We're used to seeing you on TV, but tell us about Steen behind the camera. What makes you tick?
Wow, that's a boring question and the wrong person to ask. I have to say that to some extent I'm both blessed and cursed by the fact that I am 110% interested in everything. So what makes me tick is reading, trying to understand, and then every time I put my head on my pillow every night, I realize that I only accomplish to move one step backwards and not two steps forward. So I find what really makes me tick is trying to understand how the market works and how the world works in these days, especially with the disconnect we have between the markets and the real economy, and that's really what concerns me the most.
Okay, you mentioned your thirst for knowledge and reading. We understand that you speak and you read Russian, and that you may be friends with Mr. Putin. Tell us about that.
I don't actually. I don't know where that story comes from, but I can say that my good colleague, Mr. John Hardy, was educated in Moscow and has certainly a great affinity for vodka. But it is true to some extent that I'm probably one of the few bankers who's been on Kremlin's personal website once. Can't even remember, but I think it was due to the outrageous predictions having some sort of thing that resonated with the Kremlin official webpage of Putin. So yeah, I've been on his webpage. At least he doesn't hate me.
Talking about your friends or maybe your colleagues, if they were to describe you using one word, which one would it be?
Negative. I think for some reason the fact that I like to understand things and ask a lot of questions makes quite a few people think that I have a negative outlook on the world. I think actually as a person I'm exactly the opposite, but you know, unlike I guess the majority of people today, I'm always willing to look at the sort of the holes in the argument and trying to make it make sense. A classic example, of course, right now being the green transformation and the use of electric vehicles. It's not that, of course, I'm against climate change or climate protecting the climate, but as an economist and as a thinking person, I need to alert people to the fact that the electric vehicle is probably one of the most ridiculous schemes that's ever been constructed in the history of man. So when you say stuff like that, of course, you don't become the most popular, but I'm pretty sure many people at Saxo HQ find me relatively arrogant because I don't do a lot of small talking as well.
Talking about Saxo HQ, we know that you've had quite a fruitful career. At one point at Saxo, leaving Saxo, and then you're back, happily. Tell us a little bit about that.
Well, the only time I left was after 10 years at the banks. I had been part of what is now called ET, the executive team, and after 9/11, I felt, and Lars Seier at the time felt that it would be a good time to start up a hedge fund. I did a hedge fund. We accumulated a nice chunk of capital as well, and we did quite well. But as the new management team came in, and nothing to do with them, but just the changing of the scene, changing of the landscape, meant that I felt I needed a break from Saxo. But what I realized very quickly is that, at least in my working life, Saxo is very much in the DNA of me, and I think to a large extent, I see myself as a representative of the Saxo DNA. So I was very happy when they offered me to come back and pretty much take the same position.
You talk a little bit about your own personal DNA, so a little bit of a serious question. What's your favorite flavor of ice cream?
I don't actually like ice cream, so it's very easy. But sorbet I like, lemon and grape sorbet, if that counts for ice cream.
I'm sure it can. Um, Let's take it back a little bit to Switzerland. So, what do you think about the Swiss National Bank's financial policies?
I think it's a very interesting financial exercise. Effectively, the Swiss National Bank have become one of the biggest hedge funds in the world, and the way they seem to be conducting policy is one where they aggressively pursue a policy of weakening the Swiss franc. I think it's interesting that the international community allows Switzerland to get away with effectively trying to devalue their currency on a regular basis when you at the same time have, of course, China being a currency manipulator. So I think maybe one of the shock statements with the new American policy on foreign policy could be that Switzerland ultimately become a foreign exchange manipulator as well as done by the Treasury in the U.S. But overall, Switzerland is an extremely productive and rich country, and the Swiss franc crisis and overall the way Switzerland always deals with crises is most impressive. So I'll say, if you allow me to say that the S&B is the agent of the Swiss financial market and the Swiss economy, then I have high praise for it. But I must say, I think in the statutory rules for what Swiss National Bank is, although of course theoretically it's a private bank, then I think has nothing to do with a public mandate to be a hedge fund manager. And even thinking that through that policy you can weaken your currency. I think it's something that one day will come back to bite the Swiss S&B. But overall, very impressed with Switzerland.
Very clear. You talked about moving into the next century, and I want to bring up your 100-year portfolio. A really interesting sight to behold. A lot of client interest, but also a lot of questions. Some individuals argue the validity of it. They say the investment horizon is too long. Is that the question they should be asking? And if not, if so, how would you respond?
No, they are in full rights to question everything, but what they need to understand is that academic papers and experience shows us that 95% of the return you get from a portfolio comes from the asset allocation. So what's important is not what you put in the equity basket, but how much you put in the equity basket. And the 100-year portfolio is built on a principle that has lived not only 100 years, but thousands of years, which is that if you want to make money in the short term, you have to think long term. So I will humbly disagree, and also I don't feel that the 100-year portfolio is not a concept. I'm alone in talking about. Actually, my inspiration came from as you know, from the Artemis Fund of 100 years old as well. So I think it's probably the single biggest renewal or visit back to the times where we had multiple asset allocation. What I think I brought into it was the fact that allowed cryptocurrency to have a position, allowed volatility to have a position. As you know very well, I've been very dominant on inflation calming since last year. So all these things plays into a portfolio that still, of course, also has a huge carry from equity. But I think the beauty of the 100-year portfolio is that it follows all of the rules that exist and that works, which is, one, you have to be diversified. Two, 95% of your allocation return, return comes from allocation. Number three, compounding of your return is what matters, not single years. And finally, that it has a Sharpe ratio, which is almost unbeatable. Beauty of all this is that you don't have to have a view on the markets. What you're doing is that you're extracting a proportion of your portfolio's illiquidity, which is what you're paid for as an investor. You have some carry from the equity dividend, from the credit, and from others. And then you're also willing to pay an insurance policy with being long volatility against it. So you are realizing that should we experience something similar to what we did in February and March of 2020, we will have to have a volatility asset in the allocation, because it is simply today the only asset that is not correlated to the rest. There is simply, because of the financial QE, because of the liquidity provision that has happened to the world, only long volatility sits opposite all of the assets. So I think from my perspective, it's a portfolio which was done and created as an educational model. It was, as you probably know, the 100-year portfolio was actually an extension to our inflation talk. But as you say, and rightly so, a lot of clients are massively interested in this 100-year portfolio, and for good reasons, because I think it's very difficult today to create a portfolio that has a positive return expected.
Very clear. An extremely interesting portfolio. Another interesting portfolio that we're interested in is yours. Can you tell us a little bit about it?
Yeah, so when I was younger, I traded very aggressively. As I alluded to before, I actually ran a hedge fund, so of course I had my own money on that. But today, I have 50 to 75% of my money in the 100-year portfolio. It's taken me a full cycle of being in this market for over 30 years to realize that I cannot predict anything, but the allocation will work wonders for you. And then I have 25% in opportunities, which is I'm in a commodity hedge fund, I'm in a shipping company, and I'm in a few other things, which is really not as a total allocation, but things where I really have a big heart for, and which I'm intellectually very interested in.
Okay, that's very clear, and also very diversified. With such diversified asset classes, inevitably, fingers crossed it doesn't happen, but losses may occur. What are some of the most important lessons you've learned whilst making certain losses, and what wisdom could you pass to us?
It is impossible to go bankrupt if you are not leveraged. So the other side of that coin is that if you're leveraged, you run a huge risk from one day having the bad timing of being too long something that is going down. So being unleveraged and always having 10 to 20% cash. The most successful investors I've met around the world over the last 30 years, they are unleveraged and they always have 10 to 20%. And I think the final part, which goes back to the root of the question you had before, all of them is involved in a positive carry world. So, if you want to be short something that have a carry against you, you got to be absolutely certain you get the timing right. And as I alluded to before, I think timing is probably the most difficult thing in the world. If you think about it, there are less good traders to time the markets than there are brain surgeons. But at least with a brain surgeon, he's gone through a formal education in a hospital. Finding those traders that can actually time the market better than the majority is very difficult. So for me, it's allocation, compounding, and that works for me.
Thank you. The 80% of your time that you spend researching, of course, it's intellectually and maybe even physically strenuous. Do you ever just take a day off? Do you ever take a market detox, a day or two?
In the sense that, after the COVID-19, where I had a very good run in terms of trading, I took everything to cash and just, wanted to feel how it was not to have to look at the screen every 5 minutes. But generally speaking, I believe the saying I use, it's an awkward one, but I say it's when you're in trading, you cannot be half pregnant. It's not like you can decide Monday to Friday you are not pregnant or the other way around. So for me, I'm constantly, I think when most people see the headlines, they're thinking about the news. When I see a headline, whether it's a Saturday night or a Sunday night, I think about what the market impact on and how that fits into that jigsaw puzzle I call the macro outlook. So for me, no, I'm not really off, not even on holidays.
You mentioned a little bit about COVID-19 success. COVID-19 is still in some ways very much terrorizing the world. Do you think that there are some industries that are changed forever? What would you assume are or were the biggest losers, and where could we see the biggest success?
I think I think from a Mac perspective, what COVID-19 was really not to change things, but to speed up things. So a lot of things happened during COVID-19 that classically in an economic model or in a political framework would have taken a decade. Unified basic income being one thing, direct transfer into the low income, subsidies in all different shapes and forms, and of course the initiation and the amplitude of the fiscal support that happened. But what I think will remain after the COVID-19 is two things mainly, and one I feel very strongly for is that the labor market has changed forever. So this, give you an example, I had a lunch with a client on Friday. He's the single biggest operator in the restaurant and disco industry in Denmark. He has 6,000 employees. He told me that alone, Denmark alone, they lost 40,000 employees in the service industry, which is not coming back. And you know, classically, these has been jobs taken by people from Poland, France, Portugal, whatever, that you know felt it was a good opportunity to go to Denmark and try it out. These people are not coming back, and despite the fact Denmark now is fully, as one of the few countries in the world, is now fully without any COVID-19 restrictions, but they can't get them back into the labor market. So I think what happened to a huge chunk, especially of the lower paid jobs in the world, was that people realized that they could get by with less money, and staying with the family has a infinite higher marginal utility than being on a tube or sitting on a train or commuting back and forth for a relatively modest salary. So I think that will change the dynamics, and I think that will play into the concept of society and work. Because if you think about most welfare models, especially in Europe, it's binary. Either you are in work or you are out of work. Why don't we have something in between? And I think the next solution to this shortage of labor, especially in the lower K or in the low income brackets, will have to be they have to be incentivized to come back into the market. And I think flexibility of working hours and working place will be part of that. So I think it's interesting that it may sound for many viewers right now as a small change, but I actually think it's a massive change, because if you think about macro allocation of resources, what Greenspan did so terribly, and which has been made worse by every single central bank in the world, is that they initiated quantitative easing, which is really what we call the trickle-down effect, or the champagne glasses flowing over, which is pretty much a preset way of making sure that excess return on capital is what will then come relative to the return on labor. The COVID-19 switched that around. Now you need to pay very high marginal cost of getting low-income jobs. Think about the UK right now have a petrol crisis because they're lacking 100,000 drivers, 100,000 lorry drivers missing in the UK, partly because of Brexit, partly because of they don't want to go back to the labor market. So the impact will sit with us for a very long time. The net result is that anyone who runs a business looking at this interview needs to realize you are going to pay 15, 20, 25% more salaries or incentive over the next 2 to 3 years to keep your workforce, and in particular keeping the good people. So I think it's interesting at a time where we have peak inequality that the dynamics of the market actually takes over despite a heavy hand of government, despite massive intervention to sort of mitigate what the politician seems to think is wrong with the economy. Instead, the real economy finally is catching up to the financial, and that's probably my biggest macro play, that we've been divorced. The real economy has been divorced from the financial market. Now that the real market is coming back and hunting the financial markets, and the way I like to phrase it is that I think the physical world, the physical constraints is now becoming a bigger issue than the political aspiration, the fiscal push, and the liquidity. So now liquidity works negatively because it builds on further inequality, and fiscal push makes sure that we don't have enough metals and energy to be put through the grid system that's been underinvested 20 years. So it's very interesting for me, having seen the full financialization of markets and economy. And now we're moving back to tangible, to productivity, to people who actually have something to say, and something that will change the world positively. So very positive change for me.
Okay, very, very clear. You talked in depth about the impact of COVID-19. Now, if Mr. Bill Gates was correct in his assumption that we would have to endure a situation like this for a decade or so more, this would, of course, shift the way we look at the economy and the markets. If COVID-19 is with us longer than we expected, what sort of asset classes would you advise me to start researching?
First of all, I think we have to respect Bill Gates as a businessman, but as a predictor, he's one of the worst I've ever seen. He famously in 1989 said that 512K is enough for everybody. So I don't think it's any relevance what Bill Gates thinks. He may be one of the biggest benefactors and charity people out there, but the reality is, and this I will have to make absolutely clear, no one has any clue what is going to happen with COVID-19. I was in a conference last week where there is a scientist who's made a book about the origination of COVID-19 with a Harvard professor, and it turns out that it seems to be human built. If it's human built, I'll say there's a fair chance that it can be broken down again. If it was from nature, it would be a different kettle of fish. But the fact is, I don't know, and I don't think anyone should speculate in that. I can only tell you, coming from, again, from Denmark with no curfews in place, no COVID-19 restrictions, that life returns to normal very, very quickly. It returned very, very quickly after 9/11. It will return to, so all of these emergency, to be honest, I'm totally fed up with everything being in an emergency status. Governments keeps telling us that we're in a crisis. If it's not the one, then it's another kind. We need to stop talking about that. We need to talk about how we really change the climate agenda, how we really become productive, how we make sure young people are not left behind in the real estate market, how we define ourselves as a Europe, as a Switzerland, as a Denmark. We need to stop thinking about everything that can go wrong and think about what can be done positively.
Ending on a positive note, and in a nutshell, we understand you have a very interesting following. And in your own words, if you can, what value do you think you generate for your following, or anyone who could listen to a seminar of yours or enjoy a piece of writing of yours? What value do you think you can accrue for them?
Very little at the margin, but maybe a better way to rephrase the question for me is to say, what is the guiding principle of Saxo Strategies output, what we do and what we think about? And the number one thing I teach everybody, and I have a phenomenal team behind me, is that we are not about trying to predict where the market goes. Our role is to make people think. If I'm in a seminar or an interview or even sitting with colleagues and I can provoke you or them or a whole group of people to think 1 to 2% differently, see other scenarios than the consensus, then we have been a huge success. So from that perspective, my role and the team's role is to make sure both sides of the argument is always present. So over the course of, as you know, over the last 6 weeks, we have been very, very aggressively pointing out that we don't know when the market peaks, but we want to make you aware that we are now, 2 standard deviation above the most expensive market ever. That's our role. It is my role to provoke you by saying I think that electric vehicles is the single biggest failure ever of mankind. Renewable energy is the equivalent of taking us back to between burning wood and burning coal. It's not going to create a solution for us. It is, through the outrageous predictions that we do every year, it's not an exercise in being negative. It's really, again, about being provocative on the edge, but always based on sound fundamental logic and data to support it. And for that, I'm so lucky to work with people in the Saxo Strat teams who, most of them has been in the market more than 20 years, and all of them have been at Saxo at least 15 years these days. So I'm very proud to work with these very smart people that every day inspire me to put things into perspective.
Well, Steen, you are not the only lucky one. We were very lucky to have had you and to inspire us and allow us to think and see pictures and situations or maybe at a different angle, from a different view. So very happy to have had you. This concludes our interview, and we look forward to you coming back next time and we can continue where we left off.
Thank you for having me.
Thank you for being here.